To the extent that some of these stocks do fall, do you then say to yourself, okay, now it's time to go in? What's the price at which you say to yourself, Google, Facebook, any of these FANGs make sense to you?
Sure. I mean, we've got some charts on our website, danniles.com, that go through this. But right now, if you look at it in a bigger picture context, the MAFANGs, as I call them, Microsoft and Apple, plus the traditional FANG stocks, they were up 30 to 80% last year. So multiples went up a lot. And that's why you've got market cap to GDP, which is one of our favorite measures for the entire U.S. stock market, sitting at 1.8 times. By the way, during the peak of the tech bubble, that was at 1.4, and the 50-year average is 0.8. So valuations are extremely high. For each of these names, though, it's a little bit different. We own Google, we own Facebook, we own Amazon, we own little bits of them, but we've also hedged those names by being short a lot of the high valuation names, a lot of which got driven up during this meme rally or short covering rally, whatever you want to call it. And so, specifically with regards to Google and Facebook, which benefit as the economies open up, advertising picks up, that's where we're more focused right now in terms of benefits through the back half of this year.
We saw Cathie Woods buy into Tesla just yesterday, given what we saw with the fall of that stock. What do you make of what she's done with ARK Invest? She's clearly concentrated in a lot of these stocks that have done remarkably well, but given what you're saying, it seems to be suggesting that you think the world's going to turn into a different direction.
Yeah, I mean, I've been doing this for a very long time. As you know, I was around in the late 90s when we saw the tech bubble, and you saw a lot of stocks go up a lot based on the fact that they were exposed to great themes going forward. And Amazon's the example I always like to bring up. Obviously, a great company. Stock was at $106 a share at the peak of the tech bubble. And the revenues they were doing in 99 was 1.6 billion. Over the next 2 years, the revenues went from 1.6 to 3.1, and the stock went from $106 a share to 6. So it went down over 90% while revenues almost doubled. So, right now it's great. Lots of stimulus, lots more coming. That helps. But eventually, valuations have to make some sense. And for some of the names, I think you're going to have a real big problem, even though revenues might double over the next couple of years.
So we're looking at the 10-year now topping 1.4. So at what point do you think, how much higher does it have to go to create what I imagine you think is the tech wreck?
Yeah, that's a great question, Andrew. The analogy I always bring up, it's like smoking 3 packs of cigarettes a day. You may have no problems for years, and then all of a sudden it catches up to you. And right now, that's what we're trying to figure out with rates. Some people thought it was a 1%. Obviously, market ignored that. But right around this level, I think when you're getting close to where the S&P dividend yield is, which is at about 1.5%, 10-year treasuries are about 1.4 right now. They started the year at 0.9, I believe. I think that's when things get a lot more dicey. I think where it's really going to get interesting is when you get to April. Because in April, you've got the compares being the strongest and that the economy was the weakest a year ago. Inflation's already high. Europe's at levels we saw in 2015 in terms of their core inflation. U.S. inflation's about 1.5%. So, and that's going to continue to strengthen. So I think to your point, around here, we've already started to see the market wobble. I think it gets worse as rates go higher April through the end of the year when economies reopen.
Shepard Smith here. Thanks for watching CNBC on YouTube.